So I had to write down a little note because I was like, okay, why are Aplo and Free to Grow better together? Here's what I wrote. Because we found marketers who talk about cash flow and return on invested capital. Because Aplo found CFOs who talk about new customer contribution versus repeat customer contribution. There's a lot more
Yes.
to it, but we're
Yes.
speaking each other's languages. Yo, what's happening, everyone? Episode 1 of our new podcast. Dylan, what's happening, man?
Not much. Super excited to be chatting about marketing and finance and all things DTC ecom.
Yeah, so let's set the stage here for why the heck are Dylan and I even sitting here having a conversation. So, for those of you who don't know, my name's Jon Blair, founder of Free to Grow CFO. We got Dylan Byers over here, co-founder of Aplo Group, a growth marketing agency. We've been having lots of conversations, I don't know, last several months.
Yeah, at
Um,
least, at least.
Working on some overlapping projects and mutual clients, which really fun.
That's amazing.
That mutual
That's
client
been
base
really
has been
great.
growing. And
Yeah.
I'll say from my perspective, and I'll let you talk from your perspective about why this is so exciting that we're starting this podcast. For me, I've been searching as the founder and a fractional CFO in a firm that specifically works with growing ecom brands, growing profit-focused ecom brands. We have been searching high and low for a growth marketing agency who really gets the through line, the connection between revenue growth and profitability. And obviously like the connection of the two being ad spend, right? And I've been searching for probably a couple years. We've looked at different, informal partnerships with different agencies, ultimately because I believe that, everyone may not agree with this, but just like peanut butter and jelly are better together. I think marketing, finance, and D2C are better together. But here's the important thing. We all have to understand, both sides have to understand how they impact the other and enable one another. And when you have whoever's pushing the buttons on growth marketing, whether it's an agency or someone in-house or a freelancer, when they don't truly understand the connection between growth marketing, ads, scaling ads, ad spend, and retention marketing, when they don't truly understand how that connects to bottom line profit, not just top line revenue, and I would even say furthermore, probably cash flow and holistic financial KPIs, you run into numerous problems. And I would say one of the biggest reasons is because you have to adjust in real time. You set a plan, you set goals, and then along the way you don't achieve them, and you have to know where your boundaries are. And you know where your boundaries are by understanding how what you're doing on the growth marketing side connects to the bottom line. So I met the Aplo guys maybe a year ago, started collaborating. It's very clear that they get the connection between growth marketing and profitability. I think we both saw, at least from my perspective, how powerful we could be working alongside each other to really drive forward profitable growth and ultimately increase profit and cash flow for brands as they scale. That's my perspective. Why are you excited, Dylan?
Yeah, I mean, when one big part of what we do is implement forecasting work into the services we provide when actually doing growth work, be it paid ads, email and SMS, etc. And one of the biggest bottlenecks we face is when we come on board with a new team and start getting some of those financial inputs. A, how accurate are they? Because have had issues there. B, how hard is it to actually get them? Who actually owns that inside of an org? Especially if you're like omni-channel, making sure things are properly broken out between the channels, which is not always the case. And then second of all, outside of how it impacts us doing our work to the best of our ability, is actually just straight up some of the most common issues brands face when trying to scale. So obviously there's like the obvious ones like how does new customer ROAS hold up over time? How does LTV play out over time? How does product strategy play out over time? But I think one of the biggest things that does not get talked about in D2C is cash flow planning, because in the D2C space, when you're buying inventory, you can kind of think of these as like a bunch of bets with some sort of return on invested capital expectation in the future. And I think that this doesn't get enough attention, and people need to be working more with people like yourself and the Free to Grow team to actually properly make those bets and make like financially informed decisions, because we've seen it time and time again where you start getting into the high seven figures, low eight figures, and beyond. And the size of your bet starts getting a lot bigger financially, just in terms of the POs and the invested dollars you have to put in. And those are the types of things that you cannot afford to do without like a data-driven backing in the decision-making process. So those are the two core reasons why we're most excited. It's been great working together and collaborating together, and super stoked to now have the pod together.
So I had to write down a little note because I was like, okay, why are Aplo and Free to Grow better together? Here's what I wrote. Because we found marketers who talk about cash flow and return on invested capital. Because Aplo found CFOs who talk about new customer contribution versus repeat customer contribution. There's a lot more
Yes.
to it, but we're
Yes.
speaking each other's languages. And I'll say this: you called out something important. It's about the enablement of each other's functional success within growing a business, right? That like we can be the gatekeepers of accurate financial data, like unit economics, fixed operating costs. If we do the bookkeeping, we can say, hey, Dylan and team, we know this stuff is accurate. So when you go build out your contribution margin models, which you're using to make day-to-day button pushing, ad spend decisions, you can feel confident that you know the impact on the bottom line. Whereas you and I have talked about, and I've talked with other people on your team about, when you have assumptions in your financial model that you're not confident in, you can only, you're not going to be as confident in what the bottom line impact is, and vice versa for us. When we analyze the profitability of a scaling brand, one core component of that is the profitability of the ad spend efforts. And if we don't have confidence that we can speak to the people who are pushing those buttons and understand the dynamics of like how they're making decisions and how they think it connects the bottom line, then we don't have confidence in telling the brand that like, hey, where this growth marketer is taking you is the right place that you should be going. And so like finance, marketing, and D2C definitely better together. And so before we dive into today's topic, I want to set the stage one level deeper of why we're doing this podcast. There's a lot of surface level discussion about surface level buzzword ridden discussion about the collaboration of marketing and finance in the D2C world. In social media channels where you see a lot of this stuff, you know what, like it's not long form content, it's short form content. So you can only go so deep, right, in the conceptual discussion. And I know, and Dylan and his team know, that in reality, we have these mental models, we have these frameworks that are ideal, they're idealistic, but we get out there and we don't operate in a environment when we're scaling a brand of idealism. We operate in an environment of uncertainty, right? Of changing environmental conditions. And so in reality, scaling a brand with collaborative marketing and finance is a fluid situation, right? Where we're always using mental models and frameworks to make sense of the world we're in. But we're having to also make judgmental calls because a model can't explain 100% of the world. And so we're doing this podcast so we can get deep into talking through these models and share stories, right? About like, hey, this mental model tells you this sounds really easy, but when we get in the real world, here's how it's used. It's not really easy, but it can still guide us towards better decision making. So let's dive into our conversation for today.
Let's do it.
We have a ton of stuff to talk about in the coming weeks and months, but it was obvious, I think, to both Dylan and I that we start with a discussion around aligning marketing KPIs with financial goals. I would say this is the thing that we encounter most frequently when we get asked marketing questions. Do you guys encounter this quite frequently when you get asked about financial impacts of what you're doing?
Yeah. So I think that like it's for a brand owner important to understand, or a marketer internally, like what is like the North Star metric we're going for. And usually it's some amount of year over year growth while maintaining X% of contribution margin or net margin. At Aplo, we like contribution margin. Free to Grow, I believe it's the same too. net margin can sometimes work. But when you start getting omni-channel, it gets a little bit messy with how you like allocate fixed costs. More John's wheelhouse than mine.
For sure.
So we get that a lot, and kind of working backwards from there. My outlook is that the contribution margin dollars is like normally the North Star metric, and then working backwards from there. And for most brands that we work with, what you'll tend to see is over time, let's say there's a contribution margin target of 30%. A large amount of scale, you may not be able to obtain 30% contribution margin on first order. If you can, that's amazing. So what happens is your return customer revenue sets the cap, so to speak, on your growth rate, unless you're willing to go lower on a contribution margin as a percentage outcome. And it's kind of then becomes like the never ending balance. And I think where a lot of brands kind of get stuck is deciding what that contribution margin as a percentage or dollar figure should be, because it has different implications to how much money you can pull out of the business, how much money you can reinvest into inventory. Can you do it? Can you make that number lower if you have a better cash conversion cycle? And I think that's when it starts to kind of get out of our realm a little bit. And we have to hand it off to your team to really explain and understand the economic reality of the business for how to go and execute.
Okay, so there's a couple. I'm going to throw something out there that I think we can probably, I don't want to say argue, but we can pontificate on for a little bit here, right? It's like,
Yep.
I actually am becoming more and more of a non-believer in the contribution margin ratio as a target or optimizing KPI. Keep in mind, when we say optimize, we're talking about like we're starting with that North Star
Yep.
or KPI we want to optimize for, and we're like reverse engineering everything else to try to drive that number, right? And so
Yep.
you have to be careful about choosing what your North Star is, because you could set off this chain reaction of optimizing for something that hits your metric and you get there and you're like, shoot, I didn't get what I wanted on the bottom line, right? Which is really like what pays the bills. And so let me say from the CFO perspective, or in other words, what Dylan was talking about in terms of that contribution margin percentage as a North Star, if you decide that. Contribution margin percentage of revenue, or CMR, contribution margin ratio is what they call it in the finance world. That is contribution margin dollars divided by net revenue. It's a trap, in my opinion, to set that as a target, because we don't know as we're scaling. We don't know at what points in ad spend CAC is going to go up to certain levels. Well, actually, we don't know how new customer CAC for sure is going to the penny behave as you scale. We don't know for sure how repeat purchase is going to behave to the penny as we scale. So what creates that percentage, that contribution margin ratio percentage, really is the interplay of those two things as you scale. And because there's so much uncertainty as to exactly where those things are going to land, I've found time and time again that when you set that percentage as the North Star, what you're optimizing for, it can get chaotic with trying to achieve it, and it actually can leave margin dollar scale on the table. And so I'm a much bigger fan now of let's maximize contribution margin dollars. So do you agree, Dylan, or what's your take on that?
Yeah, I think that when you're just starting out, if you're trying to, like, I think my take is that if you're just starting out with kind of thinking about setting financial forecasts and KPIs, starting with that as a percentage may make sense, as I think it gets a little bit simpler. And if you're trying to model out the business month to month, and you're not trying to do like some super long-term forecast, as long as you're updating it every couple of weeks to every month, I think that is potentially sufficient. I think when you start running on dollars may allow you to squeeze more opportunity out. But if you kind of like contract the percentage of contribution margin, I think where you have to get really kind of more advanced, and probably why you guys like this, is because you're having less return on invested capital as a percentage coming out of your inventory that you're buying. So it may impact then how much inventory you can buy for that next PO. However, you may be able to manage that with proper financing or cash conversion cycles. So I think that when you start playing that game, you can play that game, but it requires being more advanced in those other realms. If you agree with that, John.
No. So okay, this is classic. The finance guy is going to simplify what the marketing guy just said about finance really quick for
Thank you.
everybody. I'll speak about this in founder terms. And correct me if I'm wrong, Dylan, but what Dylan's getting at is the efficiency of your contribution margin, right? The higher the percentage, the contribution margin ratio is, the more efficient, the more contribution margin dollars you're squeezing out for every dollar of revenue. Go a step further, that's more dollars of contribution margin you're squeezing out for every unit you sell, right, of inventory. Yeah. And so what Dylan is saying is that you're capturing more through higher contribution margin ratio efficiency, higher percentage. You're getting more dollars into the system per order or per unit of inventory that goes out. So you may have, and the reason I say may, we'll get to that in a second, but you may have more dollars left over per unit of inventory that you have to replenish or whatever, right? Now, why Dylan is saying is that you have to get more advanced with your financial planning is because it now becomes a three financial statement, like triangulation of financial strategy. This is why you need a CFO when you get to a certain size, by the way. Like if you can manage, here's when you don't need a CFO, when you can manage your business just on your P&L, which some brands can do. I'll give you a few examples. One, dropship brands. We have some D2C brands who crush it dropship. They have no inventory. They manage their business with their P&L because they don't have any freaking inventory. So they kind of don't have a balance sheet from a D2C perspective. Right? Yeah. That's not most brands.
A lot simpler.
Yeah, that's not most brands. Most brands hold inventory, right? And so it's different for everybody. I tend to see it around 10 million in revenue, although we have brands who start working with us on the CFO front who are in their 7 to 8 figure revenue kind of breakthrough year. So they may come to us when they're at 6, 7, depending on how fast they're growing. It could be 5 if they're growing 100% year over year, which is possible. But when you get to that 10 million or approaching 10 million, 8 figures in top line revenue, it's next to impossible to manage your business well financially through just the P&L. And so what Dylan is saying is that, like, to start playing with the contribution margin dollar optimization versus contribution margin percentage or ratio as your North Star, there's balance sheet considerations because you have to figure out, this is a whole nother discussion. I don't know whether or not we go down this route. We've got a lot of episodes, but let's just put it this way. This is why a good CFO who understands D2C has what's called a 3-statement projection model, meaning it projects out 12 to 24 months, a P&L and a balance sheet and a cash flow statement so that you can sit down and you can model. And this is what we do at Free to Grow day in and day out. I can model increasing contribution margin dollars at a 10% contribution margin ratio versus decreasing contribution margin dollars at a 35% contribution margin ratio. And when I model that in the P&L, it actually flows right through to the balance sheet and cash flow projection, and I can look to see if that causes any problems. What Dylan was saying about maybe you get the right financing is, like, we have some brands who are scaling super fast. Their contribution margin ratio as a percentage of revenue is declining. It's not as fast as you think, but like over the course of several months, it's declining a little bit at a time. But their contribution margin dollars are going through the roof. They're not increasing fixed overhead, so their bottom line profitability is going through the roof. And we have put the right inventory planning strategy and inventory financing in place so that they can scale on no issues. What Dylan is saying, and correct me if I'm wrong, Dylan, when you're starting out, be more efficient because you don't have maybe the sophistication to measure those other things. If you're more efficient, there's a decent chance that, like, you know.
Yeah, I mean, idealistically, you could always run like the most advanced system possible to maximize everything. But if you're like, especially like the lower 7-figure range and just kind of in your coming up, like you may not have the ability to have like the perfect team structure built to have like a person running each kind of part of the operation, if you will. And it's a lot simpler and arguably safer if you run as a percentage. But it's probably not the optimal. In fact, it's almost certainly not the optimal way to run things. That was more the point I was getting to.
Yeah. So, okay, I'm smiling. Maybe I'm smiling for no reason, and I'm like totally off base or misguided here. But like, you must get asked all the time, what should my ROAS target be? Or stay within this ROAS target? Or like, what are your honest thoughts on using ROAS as your North Star, not as a metric you do measure and track, but as it being the North Star.
Yeah. So anytime I talk about ROAS, I always want to say, what ROAS? Are you talking about?
We need shirts. We need we need shirts,
What ROAS? Facebook ROAS, Google ROAS, new customer ROAS, full funnel ROAS. The one that we use the most at Aplo is new customer ROAS. So just new customer revenue divided by ad spend, and then have an understanding of the variable costs that go into selling your new customer's product to understand how much roughly contribution margin you're creating on first order or lack thereof. And that's the one we use the most. Are some brands where you can't use that metric as well? If paid acquisition doesn't make up like a sizable percentage of the overall pie, that's a whole other can of worms where you got to get into third party. That's almost like a different discussion. We can go there if we want. But for most brands over time that are predominantly paid advertising as the primary source of acquisition, that's the metric that gets used the most. And then back from there, we're trying to figure out which in-platform metrics are most correlated with driving that outcome. And one of the most common things we see that is wrong, and it's not always the case, sometimes it is good to have view attribution. But specifically for Meta, just removing view attribution from your Meta optimization will often see you having more correlation with your new customer ROAS outcome if you're running, say, 7-day click or 1-day click in platform. So ROAS has utility. But ultimately, it's all trying to link back to new customer, and new customer ROAS is trying to link back to new customer contribution margin, more dollars. So that's kind of how we think about that. And I think it's also very important. Again, like if you want to set these metrics, you have to understand above that, like contribution margin is the North Star, but like what is that? Is it a dollar value? Is it a percentage of value? And it all kind of works backwards from there, where it does have utility. Or I think it doesn't have utility is if you say Google ROAS has to be X, Facebook ROAS has to be X. We'll sometimes do things in platforms that will make the returns look worse because we're actually shortening the attribution windows that the platform can attribute sales. But in doing so, sometimes that actually leads to better business outcomes because it's basically like pushing the platform to show ads to a specific type of person along the funnel. Yeah. So the in-platform reporting usually is a really bad way of measuring like true economic outcome, but it's important that what you're doing in there is correlating back to that economic outcome. And this is one of the most tricky parts because it really varies brand to brand. Most brands we work with are like, there's no like, this is like the exact way you should run it. Like some brands, 7-day click, 1-day view is great. Some brands it's 7-day click, some brands it's 1-day click. How are you bidding, et cetera, et cetera. So yeah, definitely a common talking point.
I just thought of something that is sort of a tangent as you were talking though, but another trap in setting contribution margin ratio as your North Star KPI is the denominator is net revenue, which includes returns, includes refunds and discounts. And you could be in a period like January where refunds are through the roof because you have 30-day returns after the holidays. That can really mess with that. But another thing is discounts as a lever, right? Like we have seen brands that have like heavy subscription, like they have like really strong subscription base. We've seen them, we've messed around with our financial model and gone like, hey, let's increase the discount for opt-in to the subscription. Yeah. And it reduces their new customer ROAS and ultimately it brings new customer contribution margin dollars down, maybe even negative. But the retention, we've seen really strong retention trends where it pays itself back in monthly repeat purchase contribution margin dollars. And again, look, but the timing of those, when you make those moves, that could mess with contribution margin ratio in a given period. And it could lead you to a faulty conclusion. So anyways, that's just something that just popped into my head.
Yeah, and totally. And what you just described is one of the, like, if you have a subscribe and save product or a product that has like a one-time purchase and a subscribe and save option, playing around with that is like, in our experience, like the biggest way to increase LTV is just getting more opt-ins to subscribe and save on that first order. And then if you're going to give more away in terms of margin dollars on that first order, making sure that the historical LTVs that you have from from a typical subscriber actually warrant that margin dollar hit. And then maybe adding in some buffer there too, just because sometimes the larger the discount you give on that first order can sometimes have an impact on retention rates when things go to a different price in the future. And totally agree on that. And that again is why it's so important to understand that like it's almost like a trade. I'm going to trade some contribution dollars this month for more contribution dollars in the future. And is that like the financially best thing to do for my business? And yeah, I love that strategy. It's a great one.
Man, I'm like already visualizing every episode in our entire podcast for the next like 6 months. Like, so I gotta like slow my roll. It's just episode one.
Yeah, exactly.
Come back for all the stuff that's jostling around my crazy brain right now. Okay, so generally speaking, Dylan and I have laid out here like we're aligning on some measure of contribution margin. Ideally, if you're sophisticated and big enough, contribution margin dollars, right, is the KPI to optimize for. There's a case to simplify it and go for contribution margin ratio, which is a percentage of revenue. Let me really quick just remind the audience why that's important, and then I want to talk about something else that I think is it comes up time and time again, and will be really interesting for us to kind of chat around. So the reason why Free to Grow and Aplo try to optimize for contribution margin is because profit is not revenue minus expenses. Profit is contribution margin dollars minus fixed overhead, right? And so the assumption is in the short run, meaning in the month we're executing, in the month that we're tinkering with ad spend and retention marketing tactics, fixed overhead is fixed. It's not changing. It may change in future periods, but we have the fixed overhead for the current month locked in. So if it's contribution margin dollars minus this fixed number equals bottom line profit, the more you increase contribution margin dollars in that period, the higher net income or bottom line increases. That's the reason why we're trying to optimize for that. It's ultimately aligning it's basically aligning that marketing or growth marketing is trying to drive bottom line profit up and not necessarily any other metric. It may mess with it's good. Oh, go ahead.
Oh, sorry. Yeah, sorry to interrupt. With the goal that fixed costs don't scale linearly as you get bigger and bigger too. So like even if like your true bottom line is like not great, let's say it's 5% and you want it to be 10, well the path forward may legitimately just be more volume if you're creating enough of those contribution margin dollars.
Totally. And the way, and again, this is probably setting the stage for months of conversation on this show, but like the way that we at Free to Grow and you guys at Aplo assess whether there's room, whether more volume may drive more contribution margin is by understanding things like new customer ROAS, new customer contribution margin dollar, LTV velocity or repeat purchase velocity, and repeat purchase contribution margin dollars. There's a bunch of other metrics, like sub-metrics within there, but when you understand those streams, like I can look at that, even not being a growth marketer, and go, it's not impossible, but it's unlikely that increasing volume is going to help this brand right now, right? Or I can look at it and say, it would help this brand if we could figure out one of these like 2 or 3 things, right? So I want to switch gears because again, we're talking about marketing KPI alignment with financial goals. So this comes up all the time. When are times, some situations in which we may relax contribution margin goals and may be willing to actually sell product at, on paper, a contribution margin dollar loss or a much thinner contribution margin dollars. Do you guys ever encounter this? Because I know we do.
Yeah, the two that come to mind. So one is actually, I think, like a financially, not even a bad situation, is let's say you have a very high lifetime value, and let's say you lose on acquisition. So like you've actually modeled it out where it is okay to lose on acquisition because your LTV is just so good. And when that occurs, you might have a couple of months throughout the year that are just seasonally amazing in terms of new customer ROAS and or the lifetime value, because different times of year may have different cohort retention rates. And you may basically plan out your year and say, I want my contribution dollars to be X or my whatever, the profit to be Y. And I'm just going to opt in to just making this month a very large scale month. And I know I'm going to run the P&L negative this month in doing so, but I understand the benefit in doing so because I'm going to get way more customers this month. Yes, my first time customers as a percentage of revenue is going to go through the roof, But assuming the model is accurate, it is a financially good trade. And when you do those strategies, you have to make sure you have a lot of confidence in your model, understand there's some risk that it doesn't actually play out the way you expect. So how much are you willing to lose when making that trade? And then the second one, I think this is one that, figuring out the workflow is difficult, but when possible is great, is like basically stock that's just sitting there being unproductive. How do
Yeah.
we kind of have like a different set of KPIs for that? And the workflow we'll normally use when we're having conversations about this with brands is do everything possible to sell those units via own channels. So like email, SMS, where there's higher margin per order. And then if needed, if absolutely needed, consider selling it on ads. The difficult part about moving kind of like the overstocked inventory that has a year or two of supply on hand is usually they haven't sold well because they don't work well on ads. So if you have to move them via ads, you have to have a real kind of honest assessment of like, is this going to do anything good for me, or am I going to actually have like less than a one ROAS? And it really depends brand to brand, but there's kind of those two scenarios that we see happen the most.
So I like, okay, so there's a couple of comments I want to make about that, and then
Yeah.
maybe some stories to share. One is the first one you brought up where it's like seasonally, there may be a season for acquisition, right?
Yeah.
Whether it's a month or a couple months. And then there's a season for harvesting that group in the form of repeat purchase. But here's the thing I want to point out. It is not there. There's always a risk. You're always placing bets when you're scaling. But
Yeah.
what has removed some of those layers of risk is the data validation historically, right? We're not just guessing here. Like,
Yeah.
see a lot of brands mess up and go like, I think people will repeat purchase if we go after them at a loss, And so Dylan is saying, like, there's historical data that leads us to believe that it's a not a risk-free bet, right? But there's data behind us placing this bet, right?
100%.
So that's the first thing I want to point out. I had a brand that you and I work on mutually. They were having actually they still ultimately had a great February in the grand scheme of things, but it was down from the holidays as you would expect. And
Yeah.
they asked me, we should acquire more new customers at a loss. And I went and I pulled open their cohort data in Shopify, and I was like, no, we shouldn't. Like, I don't see anything in here that would lead me to believe that we'll make this up in a timely enough manner that it'll pay for itself in a manner that keeps us on average. Okay, so here, let me point something out here. You'll hear Dylan talk a lot about, and I've adopted this term. I stole this from you, Dylan. But repeat purchase velocity. What is velocity, right? It's like you can think of it in a number of different ways, but one is like how many times you turn through that? Like how many times does someone come back? How frequently, right? When it's someone can come back 12 months from now and buy, and someone can come back every 2 months, much higher velocity on the cohort that's coming back every 2 months on average. We're getting more margin dollars from repeat purchase faster, right? So it's not as risky. Like, I can place a big bet on a cohort that's going to come back in 12 months, but guess what? If I lose money on that cohort acquiring them, I have to float the loss for 12 months with other capital, other cash in the bank, debt, additional equity. But if I only have to float it for 2 months, right? And I'm like, then I might be okay. And so, like, the point is, you place these bets with legitimate, like, historical data. The second one, the one we come across the most, is the overstocked inventory position one, right? And I want to explain something. Keep in mind, this is a last resort. Do not listen to this and go like,
Let's do that.
do this. But it's counterintuitive, and this is why I want to explain it. There have been times when we have helped brands improve their financial position by selling overstocked product at a contribution margin dollar loss, but a positive cash flow per unit. How the hell is that possible? Let me explain it. So, negative contribution margin means that you subtract product costs and all of your other variable costs, credit card fees, shipping, fulfillment, ad spend, and you lost money. But you recovered, included in that is your product cost, right? So let's say 20% of your revenue is product cost. If you're truly drawing your inventory position down such that you're not going to replenish all of that inventory, you actually are recovering your product cost and keeping it in the bank. This doesn't work if you have to draw that same inventory back up to levels above where they're at today. But if you're truly right sizing your inventory, I've done this with a brand before who was like, they had an inventory position of like $5 million. I was like, dude, we need to be at like 2.5 million, right? And we don't need to go back. So not only do we have a lot to liquidate, but we're not gonna draw levels back up. We have to actually draw below 2.5 million and then back up to 2.5 million, right? This took a long time, by the way. This took 13 months. So don't we didn't do this overnight. But there were times when I said, yes, sell to that wholesaler or like sell to that wholesale channel at a contribution margin dollar loss because we're going to recover the product cost. So it's actually going to add to our cash flow as long as we don't draw inventory levels back up. So that was just one example I wanted to throw out.
That is like that is like one tiny piece of why working with people like yourself, Jon, is so crucial. And I we see it at Aplo time and time again where the P&L is like the sole focus, and the P&L is super important, but ultimately cash flow is what actually pays the bills and gets you to the outcomes you want. And strategies like that are so important. And if you're not actually actively focusing on how do I optimize cash flow, that is, you're leaving so much contribution dollars on the table, essentially. So it's super important. Are there any other like most common cash flow mistakes you see in management and in the D2C space?
So obviously inventory position is a big one. So in D2C, let's assume that this isn't a brand that has a significant wholesale presence. So they don't have significant accounts receivable, right? Because at the end of the day,
Yeah.
cash flow, this is overly simplified, but from a founder's level, it's profit plus or minus how well you manage AR, inventory, and accounts payable. That's cash flow in a nutshell. So really in a D2C brand, usually the biggest payables on the AP side of that are to your inventory vendor. So you actually have to think about inventory and AP as connected, because it's not just how much inventory you purchase, it's about when you have to pay for it. So I'll give you an example. Like, you might think overstocked inventory position is the only quote cash flow issue that could get caused by inventory. No, you can have an understocked inventory position and have to prepay for everything months in advance of getting the product and still have a cash flow issue because your cash got tied up. Like, think about it. And actually, you may have a brand that's overstocked in terms of like relative to sell through. They have 8 months of inventory on hand. Doesn't usually exist, but just to illustrate the point, if you have 8-month payment terms with your vendor, it actually doesn't matter to have 8 months of inventory on hand because you can sell it before you have to pay them. So it is actually about your inventory position relative to how fast you sell it, relative to when you need to pay your vendor. If you're paying your vendor 100% before you ever sell anything, then you're always going to have a tighter cash gap than if you get to pay your vendor once half of it is sold. And so the classic example of like the greatest cash, what's called cash conversion cycle, which we'll get into in another episode. But it's that concept of like profit plus or minus how you manage your receivables, payables, and inventory. There's Amazon. Amazon is known for selling inventory that it owns, like the inventory that it actually sells itself and purchases. They're known for being able to sell that inventory before they pay their vendors. So they actually have what's called a negative cash conversion cycle, which is amazing. They get cash from the customer before their vendor is owed money. So actually they could hold, in terms of inventory days on hand, they could hold an astronomical amount of inventory as long as on average they're getting cash before they're sending it out. And so that's what I would say in response to your question, Dylan, is to think about not just how much inventory you're holding, but what's the payment schedule, because the right payment schedule can offset like the impact of how much inventory you're holding. And I think a lot of people don't. Once you get it, once you see it, you can't unsee it, but not everyone sees it.
I love hearing the strategies and like the different ways to approach it, because we've seen it time and time again where we're doing our thing, hitting the growth goals, hitting the profit goals. All of a sudden, brand is out of cash. Like we if we want to, we need to basically get more money to pay for X, Y, or Z to keep on going. And it's because of things like this where they're not thinking about the cash flow piece. And it's like much easier said than done because it is like especially if you have a lot of SKUs and a lot of vendors, it becomes a lot to manage. All super great points.
All right. Well, man, I know we could talk about this stuff for
Forever.
I think I don't know. I'm pumped for our next episodes because in my mind I think we just opened up a huge can of worms for. I'm gonna have to go into the doc of all the topics that we want to discuss right after this and just
Add more.
Type everything that's going through my mind. But like let me recap for everyone and then let you recap as well as like any kind of final thoughts that you have. But we talked today about aligning marketing KPIs with financial goals. Super important, as I hope that as we've had this discussion, you've seen how valuable it is to have a financially literate growth marketing team and a marketing literate financial team, and how when you combine the two of those together as specialists in their areas but with crossover where they can speak each other's language to one another, it's super powerful, dynamic, and much more sophisticated in terms of figuring out how to, what I call, have your cake and eat it too, scale fast and be profitable, right? We talked here today about contribution margin being the major North Star. There are some nuances to how you may want to measure it. We talked through some opportunities or times in which you may want to relax goals for other balance sheet considerations. But ultimately, if you don't have a growth marketing team and or a finance team who can explain these concepts in words that you as the founder can understand, then you're sorely lacking, and you should consider who is sitting in those seats, because you don't need to understand all the details, but you do need to understand at a high level how these different decisions that your finance and marketing team are making, like how those are impacting your bottom line. Dylan, what kind of final thoughts do you have?
Totally agreed. I think even if you have like internal teams managing this, making sure that you're developing those team members properly to understand the different disciplines, at least at like a baseline level, is super key to make informed decisions. And then, yeah, ultimately, it's also just important to know what you want out of your business, because I think sometimes brand owners will have almost like conflicting goals. Like I want to grow this much, but I want to also be this profitable. And sometimes you can't have both at once. And it's kind of threading the needle of that sweet spot. And I think that's something that doesn't get talked about enough, is like, what are your goals actually? And then let's see, are they achievable? And if so, are reasonable? And if so, working backwards from there, I think is super important. And ultimately, that's the fun stuff, is obviously not only talking about the goals, but then executing against those. So 100% on the same page.
I might have just named the podcast Baking and Eating Cake as you scale an ecom brand.
I can see the logo already.
By the way, before we kind of shut down on episode 1, I did want to call out, I think I see sponsored by Patagonia, basically. what I'm wearing and what you're wearing.
There you go.
We might have to get that figured out, Patagonia sponsorship. But yeah,
I
all right,
wish.
man. This was a fantastic episode 1. I'm already looking forward to episode 2. Everyone stay tuned for more fun combos about scaling a profit-focused ecom brand.
Let's go.